Is it the calm before the Fed storm? Live from New York City this morning. Good morning, good morning. We are just about positive on the S&P on a 3-day winning streak, about to make it 4. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Fed Chair Jay Powell about to take center stage. Following double-digit gains since the last meeting, investors look for signs rate cuts are coming next year. We begin with the big issue, a great big pivot party.
It's a Fed pivot party, and we're all invited.
A pivot.
Dovish pivot.
The market has really been very eager to price in this eventual pivot, towards easing.
Traders right now are pushing this dream of 4 rate cuts next year.
Markets have been celebrating this idea that there's disinflation in the pipeline.
We're in a slow growth, disinflationary environment.
Inflation's come down faster than many thought.
Things are at least directionally on track for the soft landing.
The market has been overly optimistic on when the Fed has cutting.
The Fed is likely a bit uncomfortable with where the market is currently priced.
They will definitely fight back.
Push back
hard on cuts next year.
On where the market is, where it's gotten a little bit ahead of itself.
We still need to respect the fact that the last mile of the inflation journey is often the most difficult.
They have to keep some vestige of this tightening bias or hawkish concerns about inflation in place.
It remains to be seen whether that pivot this time is right.
Let's have that conversation right now with JP Morgan's Bob Michael, Kathy Jones of Charles Schwab. Kathy, first to you. Will Chair Powell validate this great big pivot party?
Yeah, I think I would agree with the pushback a bit concept. I do think that the dots will indicate that the Fed is more likely to start cutting rates in the middle of next year than the previous set of dots that we got in September. So we're optimistic that there will be a pivot, but we don't think that this particular meeting will be anything more than a hint rather than a confirmation. So I think they'll drop some of the language that talks about the need for further tightening, so that will be a hint. And the dots will move a bit lower. Maybe the dispersion about the dots will come in a little bit. But I don't think that this is going to be where Jay Powell gets up and declares, oh, by the way, we're ready to cut rates.
Bob, let's talk about the moves in this market we've seen since the last meeting. Equity stocks up something like 10% on the S&P 500. Bonds have rallied hard. Bob, do you think that's going to bother him or the committee in any way, shape or form?
I think it will bother him a little bit because I think some of the measures of inflation they're looking at are probably a bit high. I don't know how he's going to do it, though, because how do you maintain some sort of hawkish bias and push back on all of this if it's been 5 months since your last rate hike? It's not credible. What we're looking for is how many rate cuts will the dots show are expected next year, and we're also looking for their year-end inflation expectation for 2024. Do they leave it at 2.6 or do they bring it down to 2.25?
Bob, you nailed it. How credible is it? Kathy, how credible is it if your 2024 dot is showing more cuts than when you last met?
Yeah, I mean, I think they have to take out the idea that there's any more rate hikes in this cycle. The market doesn't believe it, and there's really no need for it. When you see what's happening with inflation coming down, there's no reason for the Fed to keep tightening at this stage of the game, particularly through rate hikes. Again, they're still doing quantitative tightening. There's still enough tightening in the system, I think, to keep that inflation trend coming down. So it is going to be a tough balancing act. I agree with Bob. It's going to be very difficult to communicate the right message.
Kathy, where would you expect that median dot to be in 2024? I've heard anything between 2 and 3 cuts at the Fed. What's your view?
Yeah, we're looking for 3 cuts, but we're not looking for them to start until mid-year. So I think the market has 4 cuts priced in, starting as early as March. We're pushing it back, looking more like July, perhaps, and then 3 25 basis point cuts in 2024.
Bob, are you on the same page?
Yeah, it's the safe thing to do. Just put in there 3 cuts acknowledge the improvement in inflation, acknowledge that things are slowing down, tell the markets that you're going to be responsive to it. And it's pretty close to what's priced in. Again, something like 2 dots, 2 rate cuts, they're just not credible.
Chairman Powell, and that decision about 5 hours away. Mike McKee down in Washington to break it all down for us with a preview. Morning, Mike.
Good morning, John. Well, we had our last piece of data come out before the Fed meeting began, and that was the PPI. Producer Price Index comes in a little bit lower than anticipated on a year-over-year basis. Final demand 0.9%, and the core rate comes in at 2%. So definitely showing improvement there. You can see how it runs ahead now of the CPI, and it's not related one-on-one, but what the Fed's going to do is think this suggests input costs are down, and that sets the stage for further disinflation in the CPI and the PCE. So a bit of good news there, but it won't change what the Fed is thinking. The first thing we're going to look for this afternoon is the statement, of course, and the question that we have is, what do they say about the first sentence there in determining the extent of additional policy firming that may be appropriate? If they take that line out or modify it, it's a sign that the Fed is done. So that's going to be something to watch very closely. The dot plot you were just talking about with Kathy, I agree. I think the stars come closer together. They tighten up a little bit, but my bet is that what we'll see is still 2 rate cuts, which is what the dot plot for 2024 showed in September. Because if they go beyond that, then they have to explain why. And I don't know that Jay Powell is up for that today. The red line is where, by the way, the market thinks they're going to be. The green line is the median as of the September number. And then what they got to do is put out a new summary of economic projections, which will give us their views of unemployment and inflation. Will they lower those significantly? If they do, then that sets up a question of how does that compare with the dot plot expectation for interest rates to perhaps go down. And people will be asking Mr. Powell to kind of put the pieces together. We'll see what he says. And, of course, now being as it is Fed Day, I've got to ask Bob Michael, what's my question of the day?
It's over to you, Bob Michael.
Okay. And Mike, if he tries a hawkish bias, don't snicker out loud. Lower your head or you're definitely going last. I think you have to ask him how the committee's thinking on the long and variable lags has evolved, because effectively we are in the perfect soft landing right now. If you look at unemployment, we've had 24 consecutive months at unemployment at 4% or lower. And if you look at inflation, look at today's PPI, 2% year over year, bang on their target. And if you look at core personal consumption expenditures, you're looking at the last 3 months annualized at around 2.4%, way down from 6.6%. If they don't start cutting rates soon, then they're leaving the high real rate environment, that whole structure in place, even though we're already in a soft landing. So I'd like to know how they're thinking on those long and variable lags has evolved.
Well, we'll ask him whether they're close to making a policy mistake or something like that. But I think Bob has pretty much, John, nailed it there. Everybody's going to want to know the justification for, the timing of, and the magnitude of rate cuts now. They seem to have crossed that Rubicon.
Mike, all looking forward to your coverage a little bit later. We all are. Mike McKee there down in Washington, D.C. Kathy, let's build on that. Your question for the chairman in that news conference, what is it?
I'd like to know how the committee is thinking about quantitative tightening in an environment where they'll be cutting rates next year. So I know they've said that they plan to continue QT even as they cut rates, but that sets up a whole dynamic that risks having another market incident and or just being at cross purposes, tightening on the one hand, easing on the other hand. So how is that going to work? How much thought has gone into it? What are the tools they would use to manage it? And what is the optimal size of the balance sheet?
Kathy, it's such a good point. Bob Michael, have you given that thought, the sequencing of things? If they start to engage with rate cuts next year at whatever date, where does that leave QT?
I think they leave it running in the background. I think there's a feeling there's a lot of money still sloshing around in the system. It's gotten into places probably where it doesn't belong. Some of those bubbles have started to burst over the last couple of years, but the size of the balance sheet is well above anything they would like to see it. So I think they'll let it run, and then by the end of the year, they'll start to taper it down.
Well, let's get to levels in the bond market. 2-year peaks at 5.25, 5.26. The 10-year peaks north of 5%. We are way off those levels. 10-year right now, 4.16. 2s, 4.67. Bob, you've been bullish to a lot of this year on this bond market, looking for this to rally. It has done over the last month. What do you think we're going back to right now, Bob?
I think you've got to start pricing in a lot of rate cuts next year. And the market is always tentative about changes in cycles, whether they're entering a hiking cycle or a cutting cycle. And the reality is, once they start cutting rates, they do a heck of a lot. We've looked over the last 40 plus years, the last 7 hiking cycles, and we've looked at the return of the bond market the 2 years following the last rate hike. And bonds outperform cash by 13%. And the average rate cut is about 500 basis points. And if you go to the couple periods where you didn't get that, the 95, 97 period, that sort of soft landing, you got 175 basis points in rate cuts. And if you go to the pandemic, rates had only gotten up to 2 3/8%. So you got 2 3/8% in rate cuts. That still averages to about 200. So once they start going, we expect a lot of rate cuts, and we expect excellent bond market performance going forward.
But when you say a lot, do you mean 200?
I think at a minimum. I think that they get down to the 2.5% to 3% range. Take zero off the table. Every conversation I have with clients, everyone wants to know, well, if they start cutting rates, does that bring us down to the zero lower bound? No, it doesn't. We're well beyond that. That was the last cycle, and hopefully that generational episode doesn't occur again for a few more generations. Something more reasonable is to take half of the rate hikes back. Think about 2.5%, 3%.
Kathy, what kind of economic weakness would you expect for the Fed to deliver 200 basis points of cuts?
Well, I think the first thing is you'd have to see the labor market deteriorate more than it has. And, it probably will soften up a bit. We'll have to see unemployment above 4%, closer to 4.5%. Now, having said that, I know that a lot of people at the Fed will push back and say it's not necessary in this cycle because unemployment, the Phillips curve has been broken, and that's unimportant. But I think that in this stage of the game, if we don't get unemployment above 4.2%, 4.3%, it's unlikely the Fed would cut that much. But you do have to look at then the inflation side, which I agree with Bob. Inflation's coming down. The Fed will be delivering some rate cuts because, simply because inflation is down and those real rates have some room to come down. I think 2024 is really about real rates coming down.
Let's get into that, Bob. Let's finish there too. Is this a call on real rates coming down and disinflation continuing, or are you making a call on a hard landing? Which one is it?
It's a combination of both, but certainly, even if we have a soft landing, not a hard landing, if you take the Fed at its word, and they're saying that the long-term neutral R star is 50 basis points, they're telling us that they're cutting rates to 2.5%. just to get to neutral, because they should be at their 2% inflation target, or they're not going to be cutting rates. So 2.5% gets you to their long-term neutral rate. So that's about 300 basis points in rate cuts just to get there. I can get there simply on the improvement in inflation, and we're seeing disinflation everywhere. If there's a hard landing, I think they get there much more quickly. I think you see a lot of 50s and maybe some 75s.
Wow. Interesting. We'll continue this conversation. Bob Michael, Kathy Jones sticking with us. Equities just about positive by 0.2% on the S&P with some movers. Let's say good morning to Katie Greifeld.
Hey, John, let's kick off with Tesla here. Falling slightly. That's after recalling more than 2 million vehicles after a U.S. regulator determined that its driver assistance system didn't do enough to prevent misuse. You can see shares down about 1%. Moving on, you have Vertex Pharmaceuticals up about 5% pre-market. That's after announcing positive mid-stage study results of a non-opioid treatment to treat chronic nerve pain from diabetes. It's a different story for Pfizer, as you can see there, falling after delivering a disappointing sales and profit forecast for 2024, with projected revenue sales from its COVID products missing by a wide margin, John.
Brutal. More on that around the opening bell. Katie, thank you. Coming up on the program, the White House making the case for a soft landing.
We call a sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates.
The latest from Fed Chair Janet Yellen and Vice Chair Joe Biden. Up next.
We learned that the economy added 199,000 jobs again this month. Solid, steady job growth. Like that, we call a sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates. All told, we've created 14 million jobs since it took office, more than any president has created in all 4 years of a term.
President Biden saying the strength of the labor market should deter more Fed hikes, a rare remark on central bank policy as voters continue to disapprove of his handling of the economy. And Secretary Yellen saying the path to 2% inflation shouldn't be difficult.
It's certainly meaningfully coming down, and I see no reason on the path that we're currently on why inflation shouldn't gradually decline to levels that are consistent with the Fed's mandate and targets.
Bloomberg's Anne-Marie joined us now from Washington, D.C. AMH, how about that?
Yeah, they're very optimistic, whether it's the White House or the Treasury building. A rare comment, Jonathan, as you mentioned, from President Biden, who really likes to steer clear of Fed's independence. At the same time, we're hearing from the Treasury Secretary, not just on inflation, but also questioning those that were talking about a recession. She didn't think a lot of that was really based on what is going on in the economy. At the moment, though, this administration, although they continue to tout a really incredible unemployment rate, below 4% for some 22 months, the fact of the matter is, when you look at poll after poll, Americans are increasingly worried about inflation. Even our own poll at Bloomberg, looking at swing states, when you look at these swing state voters, they see there's a deficit of a trust when it comes to the economy on this administration. But potentially, Jonathan, President Biden has seen this story before. 1992 elections, George Bush, he lost his re-election. He came out and he blamed it on then Fed Chair Alan Greenspan. And he said, well, if he would have cut sooner, it would have been better economic conditions. He said, I appointed him and he disappointed me.
AMH, thank you. The latest down in Washington. Bob Michael, Kathy Jones back with us. Kathy, the distance from 4 to 3, from 3 to 2, the difficulty of that last mile. Secretary Yellen saying this, the last mile isn't especially difficult. Is that good economics or just good politics?
I happen to agree with her. I've never been in the camp that says the last mile has to be the most difficult. Now, this is a very different cycle than we've seen in the past. It's probably more similar to the post-World War II cycle than it is to a demand-driven type cycle because we had such supply issues. So I tend to think that we have momentum on the downside in inflation. It doesn't have to be that difficult from here. Could there be some bumps in the road? Sure. But I don't think that given the restrictiveness of policy right now, the way the trends are going, I think it's very likely it can continue.
Bob, how difficult is that last mile?
Well, I'm with the ladies on this one, with Janet and Kathy. Inflation's going down like power windows. And you could look at the PPI, you can look at 3-month annualized rates, you can look at oil. Oil was up today. It almost got back to $69 a barrel. This is disinflation. And it's disinflation at a time when real rates are really, really high still. And that's still applying a lot of pressure to the system.
So, Bob, Secretary Yellen also pushed back against recession calls as well. Let's put it all together. If the last mile's not that difficult, how much economic pain would you expect to see then to get down from 4 to 3 down to 2?
Yeah, I think that's a really good question, because a year ago, I thought today we would be in recession with unemployment above 4% and inflation below 2%. And clearly we're not. And looking back over it, I think the policy responses have become so targeted now. The Fed delivered a targeted 200 basis point rate cut back in March for the banking system. So I think it's possible to get through this with a mild recession. I don't think the laws of long and variable lags have been repealed. So I still think there's still some downside, but it's taking a lot longer to get there thanks to all the money in the system, plus a lot of the policy responses. So it doesn't have to be that painful.
So, Bob, if you've changed your view on that, have you changed your view on credit?
Absolutely. And if we go back to September, we realized that this was going to play out more slowly, that the first thing we're going to go through is an environment that is a soft landing. We're in that now. So we've looked for opportunities to continue to add duration and to continue to go back into the bond markets and pick up credit here and there.
Kathy, are you on the same page?
I'm probably a bit more cautious on the credit side. There is a lot of refinancing that needs to be done, particularly with smaller firms going through the banking channel. So we're a lot more cautious, say, on bank loans and high yield, just because the spread isn't that wide. We're not looking for a big catastrophe, but if there is a problem, it's probably going to show up when these smaller companies need to refinance in the next 6 to 12 months at much, much higher rates than they borrowed originally, 4 or 5 years ago. So a little bit more cautious there, more neutral on high yield at these levels than aggressive. We like investment grade corporate bonds. We like agency mortgage-backed securities. We think there's some extra money to be made there, but we have a much more up in credit quality bias.
Kathy, wonderful to get your views. Kathy Jones and a brilliant Bob Michael, the two of you, just two of the best in fixed income. Always appreciate it. Coming up next on this programme, the morning calls, and later, Morgan Stanley's Jim Caron joins us around the opening bell from New York. This is Bloomberg. 'Stocks just about positive. Here are three morning calls this morning. Your first from Citi, downgrading Church & Dwight, highlighting the stock's rich valuation. Your second call from Truist, initiating coverage on Microsoft with a buy as AI projects go into production. And finally, Oppenheimer, downgrading Hertz, pointing to ongoing challenges to EV initiatives. That stock down 1.6%. Coming up, Morgan Stanley's Jim Caron on the risks and opportunities emerging from today's Fed decision. Your opening bell up next. 25 seconds away from the opening bell this morning. Good morning. We're calling it the calm, maybe before the Fed storm a little bit later this afternoon. Futures just about positive by almost 0.1% on the S&P. The move we've seen since the last Fed meeting on November 1st has been absolutely ridiculous. We've seen almost 10% of gains in that very small window on the S&P, and more than that on the Nasdaq. There's your opening bell. Switch up the board and get to the bond market. In the bond market, we've seen a move of about 70 basis points lower on a 10-year since then. We're down to 416.80 on a 10-year this morning. In the FX market, tug of war between the Fed today and the ECB tomorrow. We go nowhere. 108, 107.98 on that currency pair. Crude just about positive, still in the 60s, 68.79. On WTI, that one has been a surprise. About 25 seconds into the session, totally unchanged on the S&P 500. On the Nasdaq, just about positive. One stock to watch at the open is Pfizer, delivering a disappointing forecast. Ed Ludlow has the latest this morning. Morning, Ed.
Yeah, good morning, Jonathan. The stock down 7.5%. That puts it on track for its biggest drop since January 2009, believe it or not, if it's to close at that level. It's all about the 2024 financial forecast. Sales of $58.5 to $61.5 billion. The problem being two stories. The first, its acquisition of cancer drug maker Seagen, which is expected to close Thursday, is going to have a negative impact on revenue of about $3.1 billion. And the street's worried because they're saying, well, hold on, you're supposed to buy Seagen to diversify your offering and move away from the other story, which is demand for products relating to COVID-19, pandemic-era vaccinations and treatments. Within that sales forecast for fiscal 24, they're expecting about $6 billion less sales than Wall Street was hoping to hear about in the next fiscal year. So two stories happening. The growth isn't necessarily coming from the Seagen acquisition that the market was expecting, and at the same time, that demand for COVID-19 treatments and vaccinations clearly tapering off, and the stock now down 8.4% as we speak.
Thanks for the update, mate. The stock is lower. Hit hard this morning. I have to say, though, away from the stock, isn't it a good thing that the COVID boom is over? I would say it's a good thing. Not for the stock, I understand that, but for us, for human life. About 2 minutes into the session, less of that. We are just about positive on the S&P 500. On the Nasdaq, we're positive by 1/3%. Let's turn to the automakers. Tesla recalling more than 2 million vehicles. Craig Trudeau joins us for more. Craig, just how bad is this? The stock is lower by only 0.8%.
Yeah, so there's some puts and takes here, of course. With Tesla, the fanboys will say, this ain't a recall, this is just a software update. It's true that is, for now, what is happening here. This has to do with whether or not Autopilot, the driver assistance system that Tesla has been marketing for years, does enough to make sure that when you're using it, you're paying attention, you're keeping your hands on the wheel and your eyes on the road. Tesla has had hundreds of crashes with customers using this system, and some of those have been fatal. And so, you know, this is a recall that actually is a couple of years in the making since the auto safety regulator, NHTSA, opened a defect investigation into Autopilot. And that investigation will not end as a result of this recall that Tesla is initiating now. They're going to continue to monitor whether or not the remedies that Tesla has announced are sufficient and whether, you know, this really addresses the problems that have been raised.
Craig, you remember about a decade ago the Takata airbag incident, and the recalls are something like 40 million compared to the 2 million right now. Do you think just we are, in general, more critical when it's new technology, when it's EVs, than when it's the old stuff?
I think that's one of the really important things about this technology is that, of course, there's real potential here for it to reduce crashes and actually make roads safer. That's a good thing, and that's why the regulators have taken a relatively light touch approach to this technology. But it's really important that if the technology doesn't go so far as to make your car autonomous, if it does not make your car self-driving, it's really dangerous to oversell the capabilities and, you know, lead to drivers thinking that they can tune out. And that's really what is sort of the crux of the matter here. And that's something that Elon Musk has taken a lot of heat for years, branding some of his capabilities as full self-driving when they're not. And, you know, even using terms like autopilot, I think, you know, that, of course, is maybe a little bit of a closer call as to whether or not, you know, that goes too far. But certainly it's been a problem for the company for years that they've had this perception of overselling their technology. And if Musk himself is to be believed, this is the technology that makes Tesla special, right? This is the reason it's such a valuable company. If this, you know, shakes the confidence in the direction of this technology, that's the bigger question for Tesla.
Interesting. Craig, thank you. Craig Trudeau there with the update. Not shaking the confidence of investors. We're down only 0.1% on Tesla right now. More on that story a little bit later. The broader market's still positive by 0.14% on the S&P. Let's turn to the airlines. Southwest raising its outlook for jet fuel prices. Katie Greifeld has more. Hey, Katie.
And you can see the stock dropping from the bell after Southwest said that revenue for each seat flown a mile will decline by no more than 10% in the quarter versus a year earlier. That's according to a filing today that we're getting these updated numbers. That is slightly better than the earlier forecast for a year-over-year drop of about 11%. So again, slightly better when it comes to the revenue outlook, but short of the guidance boosts that we got last week from the likes of JetBlue and Delta, both signaling strong year-end demand. And Southwest would tell you that they also see strong year-end demand, that they had a record Thanksgiving, but domestic-focused carriers in particular, they've been really plagued by an oversupply of plane seats that's forced some of them to cut fares. And as you mentioned, you also have those fuel costs to contend with. Southwest actually raised its outlook for jet fuel prices by about 10%, or rather 10 cents per gallon. You add it all together, shares currently off about 4%, John.
29 per share in the early part of trading. Katie, thank you, as always. Let's turn to the food space. Cal-Maine closing one of its facilities after a positive test for avian flu. Alex Semenova has the story. Hey, Alex.
Hey, John, good morning. You might want to skip the breakfast eggs after hearing this one. Cain Foods is closing one of its Kansas facilities after some of its flock tested positive for the avian flu. Cal-Maine is the largest producer of eggs in the U.S. It said that the highly pathogenic virus affected about 700,000 laying hens. That's about 1.6% of its total flock. Shares were down as much as 7% in post-market trading yesterday. Not a big move lower this morning, though. Cal-Maine said that it's following U.S. Department of Agriculture protocols to deal with the findings. It's also working to secure production at other facilities in order to minimize disruption to customers. The company said that it would update investors on the detection in January when it reports earnings results. That's, of course, unless any material information comes up for any interim updates. Cal-Maine said there have been no positive tests for avian flu at any other facilities so far. John?
Alex, thank you. The stock's doing okay. It's up about 6%. We are about 4 hours and 23 minutes away from a Fed decision. Going into that, we're just about positive on the S&P 500, the Nasdaq higher here by 0.5. Morgan Stanley's Jim Karen looking at how the Fed's decision will affect next year, writing this: the naughty policy rate is the rate that is too high or too low and creates either a recession or inflation. The nice policy rate is the one that perfectly balances the two, and we achieve trend growth. Jim, I'm pleased to say, joins us right now. Jim, I want to get into it. I'm reading your note. Can falling rates be consistent with higher for longer? Just explain that for us all.
Thank you for having me on your show. Yes, the Fed is making its list and checking it twice, right, to see which policy rate is naughty or nice is really the theme. So the way that we look at this is we have to think about policy rates in real terms. That's the nominal policy rate minus inflation. So as inflation comes down, the nominal policy rate should also come down to match it, to keep the same level of monetary policy tightness in the system. That's just the way it works. And that's essentially what we call the neutral real policy rate, which is that optimal policy rate that balances growth and inflation and keeps us at potential growth. So it could be that the Fed has to mechanically lower policy rates as inflation rates are coming down, and the same level of tightness will be kept in the markets. So saying that rates are higher for longer should be viewed in real terms, nominal minus inflation, in real policy rate terms. So the nominal policy rate can come down, and that effectively could still keep rates higher for longer because the real policy rate may stay unchanged.
Jim, a few months ago, New York Fed President John Williams engaged in that conversation. It's fairly intuitive once you have it. Now, Jim, do you think that's a conversation Chairman Powell wants to have in the news conference today?
Well, one of the things that the Fed doesn't really talk about is what their view of the neutral real policy rate, what we call R star, actually is. So this has to be an estimated number. We think of it as like this magical number that's out there that perfectly balances everything. They're not going to come out and say that the neutral policy rate is X. They will be asked that question. Now, what economists estimate is that neutral policy rate is actually somewhere between 1.5% and 2%. So that would suggest that if that's the case, and if inflation is likely to be around 3% forecasted by the Fed next year, then that would mean that the Fed could cut interest rates next year by 100 basis points, which is roughly what's priced in the markets right now. The markets have about 125 basis points of rate cuts priced in. But think of the first 100 basis points of rate cuts as actually not easing policy, it's just keeping policy neutral. They'd have to cut rates by more than 100 basis points. But this has an impact on asset prices because if interest rates come down, asset prices tend to go up, and that includes equities.
So, Jim, you don't think that that call for 100 basis points of cuts requires economic weakness next year?
No, I think it could actually be somewhat mechanical. Now the question is if the Fed, and this is the question that's going to be put to the Fed today, and this is what we have to listen for, is does the Fed believe that this decline in inflation that's happening right now, is that likely to be permanent, meaning will it remain anchored at low levels? Or is there a risk that in, say, the second half of next year, that inflation then starts to rise back again and becomes unanchored? And this is what the Fed has to debate. Right. So if in all else being equal in a perfect world, if inflation's anchored around 3%, the Fed would likely have to cut interest rates next year by 100 basis points. But if they believe that there's still some upward pressure towards inflation, and there's reasons to believe that, we haven't won the inflation battle yet, that they may be slow to actually cut interest rates. And that's what we're going to be debating next year.
Well, let's have the debate on equities right now, Jim. How much of the gains for next year have we already pulled forward into November and early December?
Yeah, I'd say that. I mean, that's really the issue right now, because effectively, the calls for the year ahead forecast for next year were inflation's coming down, the Fed's likely to stop hiking, probably going to cut interest rates. All of that price performance right now is being pulled forward in 2023. That's the reason we've had this, as you said on your show earlier, a 10% rally since November in equity markets, in credit spreads, high yield bond spreads, investment grade bond spreads. All of that is compressed. Basically, that's all pulling forward that good news of lower inflation and potentially lower policy rates. Now, what that means is that the hard work begins on January 1st, 2024, because in order to get higher equity prices, you need to see another positive catalyst, which would mean upside surprise to growth. And I would argue that we've probably seen, probably about 75–80% of the pull forward of what we had expected for next year's returns. That might only leave returns left over in the equity markets somewhere around like 5%. And that's okay. But look, I wish the year began on November 1st, right? Because we'd be up 10%, right? On a year-to-date basis. But unfortunately, it begins on January 1st.
Well, Jim, in many ways, the year did begin. 2024 did start in early November because we started to price in this happy story. Year to date, I've got the Nasdaq Composite up by something like 40%, up 21 on the S&P 500, up 10 percentage points since early November, since the Fed last met. Jim, I remember a conversation you and I had almost 12 months ago. Maybe it was the start of this year, the start of 2023, and everyone was worried about downside risk. And you said upside risk is a risk as well that you need to appreciate and be positioned for. Jim, how do you feel about that now going into next year?
I still feel the same way. I still think that people are focused on the downside in the market. Certainly equity positioning would suggest that. I think there are still high levels of cash. People are putting money into bonds, and there's nothing wrong with putting money into bonds. Starting yields are higher, and I think inflation's in check. But there is some potential for upside, and it could even come from the stimulus side of, in terms of fiscal policy as we get into 2024. And as the market starts to price that, and as the market starts to think about that, you could start to see a broadening of the markets. And I don't like to make year-ahead forecasts, but if I were to make one, I would say that the broader market outperforms the Magnificent Seven, next year. So I would think that a balanced portfolio is actually going to do pretty well, because if you look at the multiples and the valuations of the other 493 stocks, it's much closer to averages. It's around 16.5 PE, as opposed to when you include the Magnificent Seven, the 1 year ahead forward PE somewhere around like 19. So it could be a little bit frothy. So I'd say that the broader market's a balanced portfolio, having some value, some growth, well diversified, even some fixed income, because I think fixed income returns can compete with equities as well, could actually give you, reasonable returns next year.
Jim, thanks for making a call and not making a call simultaneously. We appreciate it. Jim Cain of Morgan Stanley. Jim, enjoy Christmas. Great to catch up, buddy. Always is. Equities right now on the S&P positive by 0.1%, about 15 minutes into the session. Coming up next, the EV growing pains continue.
We are seeing this uptick in sales for electric vehicles that we've seen in the past. Of course, it is challenging to reshape an entire economy, to build a new clean energy economy.
Yesterday it was Ford, today it's Tesla, recalling 2 million vehicles to fix autopilot safety flaws. That conversation up next.
We are seeing these historic investments, as a result of the Inflation Reduction Act. We are seeing these this uptick in sales for electric vehicles that we've seen in the past. Of course, it is challenging to reshape an entire economy, to build a new clean energy economy, but knowing that the president has done what he could do, working with Congress to be able to make sure that businesses have the support they need to be able to make these investments, that's where our energy has been focused.
The White House reiterating Biden's big plans for the EV space during a troubling week for automakers. Tesla recalling over 2 million vehicles for autopilot safety flaws. Regulators determining the system is ripe for misuse, saying this: automated technology holds great promise for improving safety, but only when it is deployed responsibly. This on the heels of Ford slashing 2024 production goals for its signature EV due to slowing demand. Your team coverage begins right now. Ed Ludlow in San Francisco, David Welch in Detroit. Ed, just how bad is this for Tesla?
It's recall in name only, in the sense that the fix is an over-the-air software update. 2 million vehicles in the United States is basically every operational Tesla in this country across all year and model types. But it's the result of a basically 2-year double look by NHTSA at autopilot. And it is autopilot that we're talking about in this instance, not full self-driving beta. Literally the ability to maintain a speed and keep you within the lane. And what NHTSA found is that there just weren't sufficient on-screen warnings and reminders to the driver to keep their hands on the wheel and their eyes on the road. It's worth noting as well that Tesla did not agree with NHTSA in its findings, but acted voluntarily to do that soft recall, or recall in name only. But continued scrutiny of the future of driving, and another agency looking at Tesla and its technology.
A reality check on several fronts for the whole industry, David, in the last 24, 48 hours. I want to sit on Ford with you, David, just for a moment. Ford has been somewhat transparent about what's been happening with demand. We caught up with the CFO only a few weeks ago about that. Do you see the cut to production goals as just an inevitable bump in the road towards EV adoption, or is it something bigger here? Are we going too quickly?
In a way, we are going too quickly. I guess I'd say it's sort of both of the things you just described. Every technology geek, every person who really wanted an EV, and rich people who like luxury cars, most EVs are luxury cars still right now, they got theirs. And now we're trying to penetrate the mass market. And to do that, you need a better charging infrastructure, but you also need cheaper EVs. And the F-150 Lightning is very expensive. Most of them transact for well over $70,000. So, yeah, there is slowing demand. It is still growth in terms of the EV market. And it's the only place in the auto industry where you're seeing any kind of growth. So everybody needs to be there. But they are getting more cautious with their investments. Ford announced that they're cutting their EV investment by $12 billion, and I think this is a piece of that. General Motors hasn't said that, but when they're returning $10 billion to shareholders with a big buyback and raising the dividend, that tells you that they may know in the future they're going to have to slow down their investment in EVs, therefore they will have the money to afford these returns to shareholders.
David, I've been asking if this is a change in strategy or just a change in execution, and I'd say both GM and Ford would say it's the latter and not the former. But at some point, David, you start to think about maybe leaning towards hybrids and away from EVs.
I think they're going to have to, given how aggressive the federal fuel economy and clean air standards are, and the fact that hybrids are selling very well right now. A lot of consumers just aren't totally sold on EVs. They're worried about the charging infrastructure. That's being built out. There's the consortium of automakers that spend a lot of money to build out the infrastructure. So is Tesla. Everyone can use Tesla's charging infrastructure going forward. And no one's really marketing that. So consumers are still worried about it. Perception's reality. If you can't convince consumers that they're able to charge their cars and they won't be stranded and that they can afford EVs, they're not going to buy them at the pace that they have been. And I think everyone's going to have to either start marketing hard or throttle back investment, probably a bit of both.
Too true. David Welch, thank you, sir. Ed Ludlow on the West Coast and Detroit, respectively. Thank you, gents. In your equity market right now, the S&P just about positive by 0.06%. The Nasdaq up by 0.2. I'll just go through the bond market for you quickly. We're set up like this. The 2-year coming in 4 basis points on a 2-year yield, about 4.69 at the moment. On a 10-year, we're down about 3 basis points to about 4.17. This all ahead of a Fed decision coming up a little bit later. Coming up next on this program, we'll get to the trading diary, a sneak peek of the calendar for today and through the rest of this week. That's next. This is Bloomberg. Around about 25 minutes into the session, almost 26. Your equity market on a 4-day winning streak on the S&P, just about positive today by 0.1%. That's the price action. Here's the trading diary. You know what's coming up a little bit later. Fed rate decision, 2 p.m. Eastern time, followed by Chairman Powell news conference, 2:30. Thursday, an ECB rate decision along with the Bank of England, and we'll get US retail sales as well. The show a little bit later, set up as follows. Here's the lineup for the Fed special. Bloomberg Surveillance, the Fed Decides, with Priya Misra of JP Morgan, Subhadra Jayapura of SocGen, Jeff Rosenberg of BlackRock, and former New York Fed President Bill Dudley. Stacked program a little bit later. I'll catch you for all of that this afternoon. From New York City, thank you for choosing Bloomberg TV. This is Bloomberg.